Very good morning, good evening, and a good afternoon to all of my friends who are attending the webinar. Today's webinar is about multi-strategy portfolios combining quantitative strategies effectively. This webinar is being hosted by Mr. Derek Wong. Now, Mr. Derek Wong is the Director of Systematic Trading for Fortrade Investment Management Company Limited. Derek is also the founder of Golden Compass Quantitative Research and a director of the Aquifer Institute, a not-for-profit think tank in Singapore. Previously, Derek did cross-exchange statistical arbitrage in the commodity space and filled institutional order flow on the floor of the Chicago Board of Trade. Derek's educational background is in mechanical engineering from University of Illinois. He holds an EMBA for Hagen Business School and certificate in financial engineering and risk management from Columbia University. Derek is also an alumnus of EPAT, that's the executive program in algorithmic trading offered by Quantitatively. He co-authored a project on development of a cloud-based automated trading system with machine learning for the Capstone project. We do have Derek online here. Derek, can you hear me loud and clear?
Yes, I can.
Great, great. So Derek, I am going to hand over the screen sharing rights to you, and let's make this an exciting webinar. The show is yours. Just give me a moment.
Well, I'll do my best to make quantitative finance exciting.
Great, great. So I'm handing over the presenter rights to you, Derek. Thank you.
Okay, I'm hoping everyone can see my screen. I just changed slides, so let me know if that's working. Yes, okay. So I'm just gonna dive right in from the first slide. Why do we need, multi-strategy portfolios? What's the purpose? What's our goal? And the key point that people should take away from why we should use this is scale. This scaling is a massive advantage for quantitative traders versus traditional traders or discretionary traders. And the reason being is that, in developing these strategies, the same team of quantitative engineers or strategists can continue to churn out additional strategies, front-loading in the research, and then as the work continues, it actually dies down a little bit into maintenance and continued optimization. While in discretionary trading, actually the workload is distributed throughout the lifetime of the investment because they have to read more macro, they've got to understand what the financials are, or however they're trading, and hiring an intern, raising them up to be hired full-time on your team, training them to be strong enough and well-versed enough to have value-added decision-making for your discretionary team takes an extremely long amount of time. The second major reason comes from being the quantitative strategist yourself. You are like a craftsman. Once you've successfully developed the skills to create profitable quantitative strategies, naturally you'll want to multiply them. It's not like all of a sudden, Picasso stopped painting after he sold his first, masterpiece. He obviously wanted to continue to make more and more. And you will have that drive to do so because you have gotten this very hard to accumulate skill set. And the third reason here is to increase exposure to the parameter space. So here I have a 3D surface, and I believe that strategies live on a surface. So here on the x-axis, let's see if you can see my pin. Here on the x-axis, oh, that is not a pin. Here on the x-axis, you can see, imagine that these are different parameters from -50 to 50. And on the y-axis, we would have some kind of performance metric. And here on the z-axis, we would have months from 0 to 50 going out into time. If you made a point parameter set, you just picked a single point, you would be liable to have a lot of volatility as the surface goes through time. So by increasing your exposure, by attaching yourself to multiple points on the surface, you'll be able to have more robust performance as you'll average out the extremes, like you can see here at the 35 months and then at the 10. So you can see this is quite extreme, but if you had something in the middle as well, that would help average that out. So that makes more robust performance for your total set of strategies as opposed to just having a single set of parameters. And most people definitely, from the internet or forums, definitely like to optimize for a single set. And so we will discuss how this concept of scale applied across the entire surface can give you additional robustness. So let's talk about today's agenda. First, we'll hit it off with the classification of strategies. We need to understand what our strategies are actually delivering and how to separate them into different camps. You shouldn't have a portfolio just of a scattergun approach. You should understand exactly how each one of these pieces will fit into the end product. Next, we will talk about research data and strategy details. I have created a Jupyter notebook that will be shared later, but it all uses free data, and the strategy parameters are also shared so that everyone here can replicate all of the work that I've done. So we will go over that. Next, we need to have a framework for understanding completed strategies. Jumping from development into completion implementation, that's a whole different ball game. And the way I like to think of it is implementing strategies as investable assets. So once we've gone through that, we will transform the problem into a well-understood domain, which is portfolio optimization. So let's begin. Qualitative versus quantitative classification. Most people, books and texts that you see are definitely of the qualitative type of classification. It's arbitrary and subjective if you didn't get that originally. And normally this is based on the strategy's entry points, or whatever those buy or sell triggers are. And the two categories that they usually put them on is momentum or mean reversion. But this can be difficult, and if one person classifies it one way, if the strategy has mixes of mean reversion characteristics or momentum characteristics, it might be hard to say which camp it is actually in. Allow me to give you an example. Say we have a simple mean reversion system, and what it does is when price goes down, it buys, and when price moves up, it sells. Well, as we are the quantitative strategists, our job is to make improvements, and so we've decided to add a trend filter to it. I think that's a very standard thing that you have seen. The question is, now Is it a mean reversion strategy or a momentum strategy? One might argue that the buy and sell trigger is still the mean reversion part. However, if I gave this to a colleague, they might say, well, you are in the end following the long-term direction of the market because you're filtering out certain trades. So in fact, you are just still using momentum in the end. So this could cause some confusion, especially as strategies get more and more complex. A quantitative method is evidence-based and is based on, either the backtest or actual strategy's performance rather than a subjective judgment on how the interaction of the strategy would work against the market. It's important, and I really believe in repeatable research and measures. So this is repeatable by third parties because if I do this classification and you do this classification, we will both end up with the same type. And that way the strategies will be classified exactly the same at anybody at any time. And so the two types that we will be looking at are positive or negative skew. As a quick review for those of you who may have forgotten your distributions, here on the top we have a Gaussian normal distribution. You can see that it's symmetric around the mean. And underneath we have some examples of different skews. The negative skew here on the left side, you can see, has an extended left tail, a controlled right tail, and the mean is shifted to the right. While the positive skew is the opposite, we have a controlled left tail, extended right tail, and the mean has shifted to the left. So how does this apply, this characteristics apply to trading strategies? Well, in fact, these skew types give strategies certain characteristics. For example, positive skew, usually the average winners dollar-wise is greater than the average losers in dollars. It has a lower win rate percent, and of course a controlled left tail and an extended right tail. Normally, under the qualitative method, these types of strategies would have been classified as momentum. Now, negative skew, usually the average dollar winners is less than the average dollar losers. It has a higher percent win rate with a controlled right tail and an extended left tail. And this is usually classified as mean reversion. But in fact, we can see that it's the distribution that gives it these characteristics. The shift in the means is what gives it the win rate percentage, right? Because the distributional skew is shifting to the right or to the left. And these controlled tails is basically in the name. But where does this average dollar winners and average dollar losers come from? Well, that's from actually the cumulative density function of the trade's returns. So we have a question from Siddhant. Why does negative skew have a higher win rate and vice versa? So if I come back here, if the mean trade value has shifted to the right away from the zero line, it would then, the average value of the mean would be higher, and so the density you could see would be much higher. You have a higher amount of winning if this was the zero line here. So you would have a significantly higher percentage of the density on the positive side than the negative side. Unfortunately, this axis is off to the side, but if it was right here, drawn in the center, you will see that actually. I will give you another example using the toy strategies, and I will visualize that using actual trades, Siddhant. So here is the theoretical basis for that. So let's continue with the time series used. This is the data that we used. I used it from Quandl's CRIS database, and the crude oil rolling front month future. I'm not sure how many people here are familiar with futures, but everyone should be familiar with crude oil. The reason why I selected it is it has a very large history going back till 1983. Actually, ETFs would have been a great choice, but the ETFs are still relatively new. So this gave me a significant number more data. So I have 289 months of data for this. So it's statistically more significant than if I use the ETF. If you are curious about futures, I do believe QuantInsti has a webinar done by my partner who co-authored the EPAT with me, Maxime Fage, and you can check that out to learn more about what futures are, and you can download free data from Quandl, so it's quite cool. So here we go. Let's jump into the toy strategies. For the momentum concept, we're buying on strength and we're selling on weakness. So if the market is going up, we want to buy high, sell higher to close the position. And if the market is going down, we want to short low, cover lower. So we're going in the direction of the market, and the signal is very, very simple. We're using an end day look back on the cumulative return. We go long if today's cumulative return is greater than end days ago cumulative return, and we go short if today's cumulative return is less than end days ago cumulative return. So I decided to use for the momentum long strategy 120-day look back, and the momentum short strategy 45 days. This was relatively arbitrary. It's about a month and a half and almost 6 months. I didn't want to really dig into, parameter optimization because that's not what this is about. So I kind of just arbitrarily put this here, and I think these are just relatively good time frames to show what we have given how long of a data set we are using. So here's a picture of the signals that the strategy puts out. So this is, it starts long, and then, you can see we get short, long, short, and it gets whipsawed. But as the market is going up, it wants to get long, and then tries to get long again. As the market goes down, it's shorting, market is up, long, and you can see the cycle repeats until finally this move down, and it continues to short. So the rest of this trend, I think it's fairly intuitive what it's doing, and it does follow the basic logic that we set forth. So it is, buying on strength and selling on weakness. So the next type of strategy that we're using is mean reversion. And the basic concept of that is the exact opposite. We want to sell strength and we want to buy weakness. So if the market is going up, we want to sell it or short it. And then if the market is going down, we want to buy them. So I'm using a Bollinger Band on the closed price series for this. The Bollinger Band is a pretty standard mean reversion technical indicator. You guys could look it up on Investible or something. It comes in almost every platform, or if you're using Python, TALib, and it's also in R. So it's very generic. Our signals are also very simple. If the close price is less than the lower band, we get long, and if the price is greater than the upper band, we get short. Again, we stick with the end day look back is 120 days and 45 days for long and short, and plus or minus 3 standard deviations. Okay, so for clarity, for people who didn't know what the red and green dots were, they are the long and short signals on the time series. So short signal is red and a long signal is green. So here you can see we get long on the green dot, and then as price moves up higher, it penetrates this band, we get short, and then it moves down, and then we buy them again and comes up here and gets short. Okay. Yes, 3 standard deviations. So let's go back to that. Yes, 3 standard deviations. Susu, it's arbitrary. Seriously, it was just an arbitrary 3 standard deviations. That's all. So now I get to talk about diversification a little bit. It's the only, quote, free lunch on Wall Street. We have diversified in several ways that are not conventional, I'll say. Most people think diversification, I should add more assets to my portfolio, whether if you're trading a stock portfolio, I should trade more stocks in different sectors, or if you're trading, commodities, I should add different types of commodities to diversify. But here we're diversifying on strategy type, positive and negative skew, by having momentum and mean reversion type, strategies in it. And we have diversified across the parameter sets. So on that surface, we're spread out much, much more. And you can see here in the correlation matrix, actually, the momentum fast and momentum slow, they're the same type, positive skew, but actually their correlation is only 0.45. And at this level of positive correlation, you do get diversification benefits, even though they are extremely similar. And you can see against the mean reversion type strategies, it actually posts negative correlation, which is very beneficial. And again, the mean reversion slow to mean reversion fast is 0.41. So in this case, from a, say, logical or thought process, we have quite a diverse set of strategies, toy strategies to start with, that are reaching across the parameter sets, across the types, that we can start to have the building blocks of a portfolio. Now, none of this is this daily strategy? Yes. Hisek Kumar, this is daily strategy return correlation, yes. Log returns, in fact. So here we have the strategy cumulative returns. If this doesn't tell you that these are toy strategies, that they are not really for trading, I don't know what will, because it's pretty violent moves. But you can see that, some of them, like here, the momentum fast, have some pretty gnarly drawdowns, more than 200%. So you'll be ready to have a lot of margin calls on that one, while others perform, quite well, and others are middling. So we have a variety of, positive and negative cumulative returns, and they're all doing kind of their own thing. So this is quite good example for us to work through, but not to actually trade. And it's more for this educational exercise. So now that we have our strategies determined and we know how the signals are working, the next step is in fact to classify them using the quantitative method outlined before. So here's the trade returns, descriptive statistics coming out of the Jupyter Notebook. And the thing here to note is we want to look at the minimum and maximum. So we want to inspect the tails of this distributions, and we can see here for the mean reversion fast, we have about negative 0.81, negative 0.90, comparing that to the momentum fast here at about, negative 29 and negative 28. But if we compare that to the maximums, you can see the ratios of the minimum to the maximum these maximums are on absolute value are much smaller than this, and you can see these on the absolute value level are much higher than this. So we can see the control tail portion on the mean reversion, or excuse me, we can see the controlled tail on the left side for the momentum and the extended tail on the right side for the momentum, and the inverse for the mean reversion. And so let's test our classification method. From a logical standpoint, these strategies were supposed to produce that type of skew. Count represents the number of trades. Yes, the number of signals. So in this case, both mean reversion, fast and slow, are negatively skewed while momentum is positively skewed. So it does in fact fit that regime. So let's take a look at the trade return distributions in a visual manner, and maybe this will help answer a couple of the questions that came earlier. For the mean reversion, we can see that we have some significant losses, much greater than negative 0.5. This one is almost negative 0.1 here, while the winners, are about 0.6, and this one, actually, mean reversion slow does have one very large winner. But if we take a look at the momentum area, we can see that the right tail on the winning side here at 0.5 and above, but there are no losers less than negative 0.5. And you can see here we have a couple of outsized winners on the momentum fast, but on that identical area here on the negative side, there aren't any. So we can see that these four trading strategies in these two camps are. No, this is just the return of the, this is Srini. Yeah, the x-axis is not the standard deviation, it is the trade return. And then the y-axis is the frequency. So we have created some strategies. We have looked at their cumulative returns. We have checked their correlation, and we have classified them together. So at this point, we could say, okay, development is done, right? We know what these strategies do. So we need to change our mindset to implementation methodology. Because as we develop these strategies, it's normally done in a vacuum of research, laboratory, or academic type area where we are free to, try any model we want, make any different kinds of variations, and just see how that affects the strategy. But as you get closer and closer to implementation, we need to consider other interactions. And these interactions are with any current investments we currently hold, any other strategies that are already in production, the investable universe that we're working with, and any investment mandate we might have to follow. So this becomes much more practical. So we need a framework in order to make this mental and operational transition, because we need to take ourselves out of the more creative and the part I really do enjoy, the development of these things, and say, okay, well, now it's time to actually make this a reality. So a way to give yourself that mental transition is to consider strategies for allocation as investable securities. So what is an investable security? Let's define that. Well, by definition, a security is a tradable financial asset of any kind. And these include debt securities, equity securities, derivatives. I'm sure all of us have invested in some of these at some time in our life. But the question in this definition that really strikes me is, are strategies tradable? So I would like to run through a short thought experiment and go through all the different situations and see if we can, in fact, answer this question. The first thing is, how do you go long a strategy? Well, you would just allocate capital to that strategy. Why is that? Well, when you allocate capital to the strategy is now delivering to you, hopefully, the expected return series and the expected trade distribution that you expected. So it is now having that type of effect on your net portfolio. What about no allocation? Well, you just flat, right? You don't have to put any money into the strategy at all. Just let it sit there. Maybe you do paper trades with it, or you just put it back, and then maybe a month or two later run another back test and see has anything changed with it. That would be a flat situation. And what about short? You can short stocks, you can short futures, you can short FX. What would you do to do that in a strategy? And you would just invert the strategy signals in such a way that it would deliver the inverse daily returns and the inverse trade distribution. So the final question here, or the final thought experiment, is what about securitization? Almost all of these securities, right, are quote, right, securities. We can securitize them. We can create tranches. We can do crazy financial engineering on them and, rehash them into new products. Can you do that with strategies? And the answer is yes. Yes, you can. A traditional method is to create a fund. You create a fund that trades these strategies, and you get clients and they invest in you, and you deliver that strategy's returns to them. Or more recently, you create an ETF based on the signals. There are a lot of ETFs now that are value or momentum or, volatility. And so you can create these securitized strategies. But let me give you a very clear example of this. Did you know that the S&P 500 is in fact a quantitative strategy? Almost every major stock exchange and country has an equity index. And a lot of them are, in the end, market cap weighted. And they have some methodology that they follow. So let's look at the S&P 500 as an example. Actually, it's a momentum-based stock strategy. And it has quantitative filters. These quantitative filters is a minimum market cap of around 6.1 billion. And a liquidity filter, which is an average volume on lit exchanges that must have a turnover. And they have a systematic rebalancing methodology. Standard & Poor's puts out a white paper that explains exactly what their rebalancing methodology is and their weighting allocation. So it's a very systematic, governed method in order to do this. So now if we consider that the S&P 500 is a quantitative strategy, SPY is in the ETF is in fact a securitization of that strategy. So now we know that you can go long, short, or flat strategies, as well as repackage them into securities. So I would say that yes, it does fall into this investable assets securities method. So now that we can accept this, we can take a first principles approach. The motivation for investing in any asset or strategy is the same. We desire the characteristics of that underlying return series. So let me explain that. If you buy a stock or a house or gold or Bitcoin or what have you, you are looking to have that asset's effect in your portfolio, affect your P&L. So the future daily return will come and affect your account. Whether, and then later, at some later point in time, hopefully it appreciated, right? And you got those extra returns, that accumulated return in the future. So then the next natural thing an investor or a trader wants to look at is to allocate funds in relationship to our desired exposures. Now we have this kind of universe of things that we can put money in, whether it's this set of 4 strategies or any of the assets we could think of. We need to allocate it smartly in such a way that it targets what we desire, the exposures that we desire. And finally, everyone would love to maximize returns while minimizing the volatility, right? Everyone wants to make more money without being scared or having additional risk, however you want to look at it, and suffering those drawdowns. So if these 3 core principles we can accept, we can apply a transfer of domain. A transfer of domain is actually extremely important in quantitative finance, especially important in quantitative strategy, because there's no need to reinvent the wheel. This is one of the major reasons why engineers, like STEM people, are very important in quantitative finance rather than, say, a PhD in economics, because they have the ability to do transfer of domain. It allows you to bring well-studied other areas into the fold to allow efficiency and a background of a large amount of academic research that can be used into a new area. So in our case, we're going to transfer domain so we don't have to reinvent the wheel. And if we can take the view that an investment in any asset is a long bet into its return series, then we can transfer this problem into modern portfolio theory. And modern portfolio theory has been written about for decades, right? I mean, you can find a lot of information about it free anywhere online. So today we're going to use what started it all off, mean variance portfolio optimization, and it was created by Harry Markowitz, who won the Nobel Prize in Economics for this. So I'm sorry, I'm reading a question right now from Amit. Is volatility of strategy equated to maximum drawdown? If capital allocation is well defined, would not volatility of strategy be rendered neutral if we have similar volatile return matrix as compared to risk? Okay, well, the volatility of strategy equated to max drawdown, and then you're asking me if it's compared to risk. Amit, this looks like it's how you define risk, right? The volatility of a strategy might affect, your VAR, which is how a lot of institutions will look at their risk, but max drawdown might be your absolute risk, right? That might occur, once every, 10 years or, what have you, however long you tested it. So which one of these 2 benchmarks are you using to measure yourself in risk? And I think that they are kind of different. So it's not a very clear answer because it all fits into what your quote mandate is, what you're trying to achieve, how much capital you have, and other kinds of constraints. I hope that answers your question. So I will continue. So here we have the standard deviation, which is our, risk measure. We have expected returns here, which obviously we want to make more money, right? So higher is better, lower volatility is better. We have an input here of the risk-free rate. And here we have individual assets, right? And these assets in this mean variance portfolio, the examples are usually given as equities, but in fact it could be anything. And so that's where the transfer of thinking about strategies as investables allows us to fit that into this box, right? And to transfer that knowledge, okay, now this model can be applied. So now what you do is you look at all of the individual assets, you create an efficient frontier and this capital market line to find the tangency portfolio. And this tangency portfolio is the quote optimal portfolio. Why is it optimal? Because it gives you the maximum amount of expected return for the minimum amount of standard deviation. So in this case, it is right here. So let's apply this to our toy strategies. You can see here I ran 10,000 runs of different random weighting allocations to our 4 toy strategies. And you can see we do in fact have this quote Markowitz bullet shape here. And I used the risk-free rate as 0.91, which was the federal funds rate when I did this. And you can see we created this yellow efficient frontier, and the tangency portfolio is here. Now, when we look at this percentage, right, we have 0, 0, 0, 100. I admit this result is not inspiring because it picked a very extreme portfolio. And this is probably too extreme for most people because it just says buy, MR slow. Don't look at anything else. But did the optimization actually give us the insight we needed? So let's take a look at our optimization function, right? Our objective function. So basically we did the means return divided by the standard deviation, mostly. And it's a very good proxy. And so here, what is this similar to? This formula is Sharpe ratio. Now, I'm sure everyone is familiar with the Sharpe ratio. So if we take a look at this, momentum fast is 0.04, 0.03 for slow, negative, which obviously is bad, and MR slow is 0.0069. So in this case, based on this here, the optimization did in fact choose the best choice. But let's do a visual confirmation to see that. Well, if we go back to our cumulative strategies, we can in fact see that mean reversion slow had the most cumulative return, had the longest period of positive performance, and the least amount of volatility. This is its largest drawdown here. The other strategies here are quite middling. They lose, this MR fast loses more than 150% and then goes back to 0 and then minus 100%. So this has quite large negative swings in it. And that means that the volatility is much, much higher, causing this to be have a lower score. So yes, I would say in this case, the optimization did its job, although the answer might not be what we were looking for. So how can we make some possible improvements? And this is your homework. No good lecture is good without homework. So this optimization we saw was quite extreme, but that doesn't mean it's not solvable. So what we can do is we can add additional portfolio constraints. One of them might be limiting the downside to, make sure that we always have 10% of each one of the strategies in there to make sure that they all don't go to zero might be an idea. Or you might have your own ideas for this. The next thing is, logically, when we started this process at the very beginning, we knew we were diversified in 3 dimensions, right? Well, 2 dimensions, I'm sorry. We were diversified across the parameter set. We were diversified across the strategy type. So this diversification disappeared because the optimization went 100% into something and gave no allocation to the others. So you might want to take diversification into account to make sure that that doesn't happen or allows you to maximize the effect of the diversification. And the third one is use different objective functions. We use mean variance. You could use any measure of risk you want and any measure of reward. At this point, it's a creative exercise. You can combine anything how you want. I have just given you the framework about how to think about creating portfolios of quantitative strategies. You can use this and go crazy to your heart's content and discover a whole new area of quantitative strategy beyond actually creating the initial algorithm itself. And I know a couple of you were asking for where these notebooks can be found. Well, there's a GitHub, gcquant/webinars. You'll be able to find the notebook that I did all of this work in, and you will find the calls to the Quantitative API, so you can change the instrument you're trading. I also have the constraint matrices, so you can do that. You can change the optimizers. Right now it's using convex optimization. You can change everything. It's all up to you to finish that last part to make it improved. And of course goldencompassquant.com. There we are putting out some nice blogs and information that might be interesting to you in the future. So I'll hand it back over.
Hi, Derek. That was a fantastic webinar. I'm pretty sure all the attendees would agree as well. And they would absolutely want to get onto those links that you shared with us as well. Now, what I will do is let me just show them the links once again. For the GitHub link is gcquant/webinar, and the attendees can also go to goldencompassquant.com. Now, I also wanted to take this opportunity to just talk about EPAT, which is the Executive Program in Algorithmic Trading. Derek is one of the alumnus for EPAT. We've trained close to 10,000 professionals from 75 plus countries with Quantity's educational programs. So if you want to learn more about this field, you can enroll for the EPAT program now. You can hop on to our website, which is quantinsti.com. That's quant as in quantitative, insti as an institute. Or you can give us a call on the numbers mentioned below. And just remember that if you keep calm, you can be an early bird as well. We do have the early bird discounts going on till 20th of June. One more thing that I would like to mention before I open the stage for questions is that we will be sending the link for the recording once it's uploaded, and also we would be sending the links mentioned for GitHub and the Golden Compass Quants in that email. So I'm going to hand over the presentation rights to Derek again. Derek, you can take over the presentation again and take the questions that you need to.
Okay, let me show my screen again. So anybody ask some questions, type them in. I'll be going back through some of the historical questions right now, so I'll start there, and then if you guys want to keep adding, that's fine. The first question I saw here is, our mean reversion and momentum the only type of strategies that have negative and positive skew? Actually, something very interesting occurs when you use skew. The entry becomes less of a, let's say, effect on how the distribution works. Yes, there are many other types of strategies. You can have stat arb, you can have you know, traditional trend following, right? You can have volatility arbitrage. In fact, any type of strategy can be put in here, but it's how you manage the trade and exit the trade that will determine your tails. So you can have any one of these strategies actually fit in positive or negative based on how you're managing the life of that trade. So how the trade management of the life cycle of that trade becomes much more important than just the entry point. And so that's a very interesting part of why the skew method is so much more important than just using the entry method, because it can be applied to any type of trading strategy. It's not just mean reversion or momentum. Anything that produces a trade return distribution can be classified. Usually arbitrage, volatility arbitrage, stat arbitrage doesn't really fit into these things, but in fact, using this method, it can. Let's see. So we have, hi, do you, oh, he left, so I'm not going to answer your question. Let's see. See, Rahul asks, will there be any case when the risk-free rate does not intersect with the expected return? I suppose in extreme cases where the standard deviation is extremely huge, maybe, but usually it does intersect. I would have to say it's something is probably wrong with your modeling, or your strategy is like messed up if that is in fact the case, or you're not getting that Markowitz bullets shape of the efficient frontier. Your efficient frontier becomes not a parabola, so maybe like it has more degrees on it, right? So that, you know, it might be to the third or to the fourth, where the surface is changing. So it would you wouldn't have a tangency. It would go through some of the surface, and then that would mess you up. But I would say it's extremely rare cases. Let's see here. Let's see, Julius says, any thoughts about using a regime filter to choose between momentum and mean reversion strats? I think this is the holy grail of kind of this type of trading, because if you knew exactly when the trend following momentum style would work, you could activate those, and then when, you know, the regime shifted, it turned into, you know, the mean reversion style. It's extremely difficult. It's extremely difficult. You know, I haven't personally had a significant amount of success with this. I try to keep things very simple, although this might be one of those classification problems where I would say everyone is continuing to think about this, where ML might come into play, or you could use some kind of digital signal processing to see, you know, the noise, signal to noise ratios. We're looking at these two areas in order to try to figure that out. Currently, we're using more digital signal processing to solve that problem. But yes, it is It is a good question. Let's see. Amaya says, what's a good programming language to master as a beginner? Python. Let's see. Srini says, as an individual trader, what is the asset base you will add additional strategy? Okay, Srini, I don't actually think it's asset base. I think it's the minimum size of the contract they're going to trade. So if I say have $1,000, right, and I trade, the micro FX, on some OTC broker or whatever, if each of my trade only costs $1, I could easily trade 10 strategies on that. But say I have a $10 million account and I'm trying to trade Japanese bonds, which have, around like a couple million notional. Yeah, it's probably going to be pretty rough for me to add additional strategies given that capacity. So I definitely think it has to do with more what you're trading than it is how much assets you have. I hope that answers your question, Srini. Let's see. Susu says, what is the best data source for various securities? Free, Quandl, and Yahoo Finance. Paid, well, as much as a budget as you can get. I am a big proponent of buying your data because the quality matters here. It is absolutely the raw materials required for quant development, strategy development. If your data is bad, if you got a lot of like NAs or like, things are going wrong, it's not clean, and you got to call the data engineer, and 5 days later they tell you, oh, we fixed it or whatever, you got problems because you don't know where there might be some mistake. So I'm a proponent of paying. I will not tell you which vendors, but so far Yahoo and Quandl will probably get you started for free, and the data quality is not bad. It's not bad. Let's see. Bruno asks, what techniques work best to control the optimizer and prevent extreme portfolio shrinkage, bootstrap, or something else? Okay, that's a very good question. I am not that much of a fan of Bayesian shrinkage. It does work. I'm much more a fan of bootstrapping. I would say using bootstrapping for your portfolios is the way to go. The problem with shrinkage is it's much faster, but sometimes I think it gives you less robust results, and that's kind of a feel thing, because when you look at I hate to say this, but when you're used the optimizer for a long time and really kind of what you want, or like what would be normal, then it's like, well, that's like a little bit off, and you don't really know why. I would say that bootstrapping for a repeatable process, obviously set your seeds here, gives you much, because it's a numerical method, gives you much better, set of parameters for the most part. Let's see. Rahul asks, what do you mean by inverting a strategy? Does this mean taking the opposite position that was suggested? Not necessarily, but usually you want to take the opposite signal, but it's all about getting the inverse of the daily return series and the inverse of the trade distribution. So you may have some filters in there or some kind of interaction where you can't do exactly the opposite, but usually with some tweaks you'll be able to get the opposite daily return series. Partha asks, can we visualize strategy in a 3D model like backtesting? Yes. It is through backtesting that you get such a 3D surface. So you would just have to do it that many times, right? For all the parameters and all the possible different, periods, right? And then just plot it. It's not a big deal. I already answered that. Book recommendations on the subject. Active Portfolio Management by Grinold and Kahn. That is very, very good book on this. Yeah, so that's Roshan's question.
Wow, I guess that is about it, and we would be closing off the question and answer right now. Derek, that was a fantastic webinar. I'm pretty sure that all of the attendees would agree with that as well. And would you happen to have any kind of last words of wisdom for our attendees?
Just go out there and try it. I mean, there's no other way but getting your hands dirty. So pick up the notebook and just try it.
Great, fantastic. That comes from a lot of experience. Thank you so much, Derek, today for giving us your time and giving us this presentation. And I hope you have a wonderful week ahead of you. Thank you so much for the webinar today, Derek.
Well, algorithmic trading requires you to merge two traditionally disjoint set of skills. One is finance, another is technology. So you need to merge skills in finance and technology to be able to do algorithmic trading. So you need to understand the markets, you need to understand big data statistics to be able to design your strategies. But once you have designed the strategies, you need to also understand technology to be able to automate your strategies. So therefore, that is where the Quantitative's education programs come into place. So we train people about the entire gamut of operations and skills required to be able to be a successful algorithmic trader.